All right. We are live. Matt the Mortgage Guy. Every Monday, 3 p.m. Pacific Standard Time, I'm going live, answering your questions. Every once in a while, I have a guest. On that note, next Monday, 3 p.m. Pacific Standard Time, live right here on YouTube, I'm going to have Ryan Lundquist. Anybody who's in Sacramento surrounding knows that he's got an awesome blog that he's been doing for, I think it's going on 13 plus years. I think his blog, SacramentoAppraisalblog.com, turned a teenager recently. We're going to talk all about the market. There's a ton of stuff to talk about. So mortgage rates have been super volatile. The market seems to be changing, but then when you really analyze the numbers, you find stuff like inventories no longer growing at the rapid pace that we saw for June and July. What does that mean for Q3, Q4 of 2022 real estate? What does that mean for next year? The volatility in mortgage rates, what's going on in the September meeting? There is unlimited stuff to talk about if you're in real estate and mortgage. So I think that these are an awesome opportunity for me to get on, answer your questions, give you honest feedback, what my clients are saying, what the great real estate partners I work with week in and week out are saying, what they're seeing in the market, the kind of offers that are going out, what's getting accepted, what's not getting accepted. There's just a lot of stuff to chat about. So fire away with any of your questions, comments, concerns about the real estate market. What I want to start with, and I think I'm going to have Mike Simonson from Altos Research join me sometime in the next 4 to 6 weeks. Altos Research does such a great job with data. And, similar to Ryan Lundquist and what I try to do as much as I can is not just present data, but some context for the data and what it might mean for specific people in specific markets and real estate in general, right? Because you can look at data and you can draw your own conclusions. You can have somebody present data with their own bias or their own agenda, and that could come across a certain ways. I really commend my buddy Ryan Lundquist. Good to see that you're here too, brother. Because he takes that data and tries to present it where he's got no dog in the fight, right? He's just presenting it, telling you what he's seeing, what it means, how this data correlates to what's going on in the market. So earlier today, listening to some Altos Research and some Mike Simonson, really interesting stuff. We've seen inventory climb like crazy through June and July. And everybody thought holy moly, look at this inventory climb, because I haven't been quiet about it. And I haven't tried to hide the fact that demand fell off a cliff. A lot of folks couldn't qualify. A lot of folks chose not to want to buy because interest rates went up quite a bit and affordability suffered, right? And so as demand stopped abruptly, inventory started to go up. And Ryan's got a great piece on SacramentoAppraisalblog.com that shows the actual graph to show that inventory increasing was not a function of a ton of new listings. It was a function of the listings that did come to market took longer to sell. So what we're seeing right now, and what Altos Research put out in the video that they did today, is that the projections for inventory for the rest of 2022, considering the fact that there's less than 1% growth week over week on new inventory come this first week of August, is that inventory is going to kind of level off and then come down. The end of year inventory that they project, 535,000 homes, is still just well below average, not nearly enough inventory, even with demand down, right? And so some notes that I took were that, the inventory levels right now that we have, while they are 32% higher than they were last year, which is considerable, right? You think oh my gosh, inventory is skyrocketing. Right now in August of 2022, we got 32% more inventory than we had last August. Well, if you compare that to 2020, it's still less than we had that year. It's 40% less than what we had in 2019, which a lot of people like to compare to 2019 because it's the last quote unquote normal year. right? 2020 was kind of funky, especially between March and August, as people were trying to figure out what was going on with the pandemic and the C word and all that other stuff. So it's really, really going to be interesting to see. There's guys like this that are really honed in and tuned into the data saying, listen, we're not going to get an influx of inventory. The people that rushed to sell June and July created this, wave and this upward trajectory of inventory that has already started to level off. And so if it levels off or slows down inventory wise, then all the doom and gloom and crash folks are going to be way off of base, because we can't have a real estate crash without inventory increasing by a ton. 535 homes is not nearly enough, even if our demand is cut in half due to less folks wanting to or being able to qualify to buy. So let me know what you're seeing in your market. I know that for me in our market, Northern California, Sacramento specific, buyers are able to get a lot more concessions. Seems to be on somewhere between a half and 2/3 of deals where there's a seller concession of some kind. I saw one today where the offer went across on, was that Saturday? Might have been Saturday night. Rescinded the offer and then resubmitted it with a $15,000 seller concession. So these are the types of offers that are being presented. And truth be told, vast majority of the stuff that is being accepted and is in contract has a seller concession of some kind. Not to say that you're, getting $100,000 discount, but at the very least, if you're getting some seller concessions, it's good stuff. Joey Garessi, thanks for joining, man. I appreciate you. And thanks for shouting out the podcast. I don't know if I've shared that on a live, but and I probably don't even have the link up here, but I'll share it somewhere, Facebook or YouTube live. Get Better Everyday podcast. It's on Spotify. It's on Apple. It's a fun passion project of mine where I'm not just talking to mortgage folks. Episode 3 with Anthony Casa was mortgage. Episode 2 was Matty A, entrepreneur, buddy of mine. I think in the future, I've got a guy who runs a really successful Chick-fil-A. Who else did I interview recently? Austin Linney, who's got some Airbnb stuff going on. All kinds of different guests from different walks of life, all doing similar things on a daily basis to get better every day when it comes to, all kinds of things. This is a good question, Joey. I like this. Heard some of the news about Opendoor. I think tomorrow, I recorded a video like last Thursday or Friday, but it's not going to go on YouTube till tomorrow, talking about that $62 million lawsuit with Opendoor. I almost forgot about this, but I'm hearing them throwing out bonuses to buyers and realtors to get their home sold. I wouldn't know the numbers because I'm not as great with the stats as Ryan Lundquist, but if he's on, he could probably share some stats with how many homes Opendoor owns in Sacramento. They own quite a bit. And the crazy thing, Joey, is like they own quite a few that they've bought recently where you can look at the property records, purchased for $538, on sale for $550. And it's interesting to see, like sometimes you have to guess what these big iBuyers play truly is. Because if they can get fees from a title company that they own that you have to use as a buyer and or a seller, if they can charge you for repairs, where a lot of cases like the lawsuit that they got hit with, the $62 million or the fine from the Federal Trade Commission, it was them charging somebody who sold them a home $5,500 in repairs and then doing nothing to the house and listing it. Stuff like that where people kind of felt like they were taken advantage of or lied to or both, right? So interesting to see. Do you think Opendoor is looking to reduce their inventory? That's a good question. I guess, you'd want to look at like how many homes they own versus how many they have listed. Anybody who knows anything about real estate knows that you don't want to list them all at once, especially in the same market. That's not going to help, right? You flood the market with more homes. It creates more options for buyers and less, in that whole supply versus demand balance. So be interesting to see. I'm not sure what Opendoor's play is. I know that they've not crushed it. That's probably goes without saying, but all the stuff I see in my market is overpriced. And it's funny because it shows that they purchased at 538. They're selling for 550, but I can look at comps and I've got buyers in contract with a similar house for 507. So the fact that they think they can sell at 550, they're off base there, and they bought at 538. So I don't know how low they're willing to go. I actually contacted an agent on one of these homes that I had a buyer interested in as an investment. I was possibly looking at it as an investment as well. And I contacted an Opendoor agent, and they said, you got to offer through their portal or something. So interesting stuff. The last hike seems like it got laughed off. Thanks for joining, Matt Bittner. Perhaps, and I think the market reacted last week. Some of the negative stuff we saw with mortgage interest rates was the fact that we're leaning more towards 75 basis points in September away from 50, which lends itself to your point, man. The Fed's going to have to keep hiking rates if they want to fix inflation. Going to be interesting to see what we get on Wednesday. We're going to have an inflation reading on Wednesday. 9.1 was the last reading. If this number is not down and down significantly, the Fed is going to have to beef up their plan. I think the over under, I don't know, a lot of differing opinions on this. Some people think it's going to be sub 8%, which if it's sub 8% will be a good thing for rates, because then it will kind of signal to the Fed or signal to the market that what the Fed's been doing is working. Inflation's coming down. They can stay the course, kind of do the same things, and it'll fix itself over time. My favorite saying is, we gonna see. Alex Rodoni, what's up, my man? Hope all is well. Kevin Hawthorne from Lakeland, Florida. Thanks for joining, brother. I appreciate you. Good afternoon from New Jersey. Matthew Gilliard. I had somebody send me a picture from New Jersey about people lined up outside. This guy was a fellow mortgage professional. And he was telling me, man, like my market hasn't slowed down at all. It's still bidding wars and crazy. And I don't know, like I'm skeptical. Can it still be that? Can it still be that? Sorry, I didn't freeze. I was just looking for a word. That's like not a computer problem. That's 42-year-old man problem. I had a birthday last Thursday, turned 42. So appreciate all the happy birthdays. Thank you guys. Can it really still be that competitive? I think competitive was the word I was searching for. It took a while for it to download in this brain. Maybe more coffee. That should help. Some afternoon coffee. VQuez, hello. How you doing? All right, let's take a look at mortgage rates. People always like to look at mortgage rates. The best place to look where you're not going to get sold, have 97 people call you, is just going to be going to Mortgage News Daily, right? They're kind of unbiased third party where they're not necessarily trying to sell your information to 72 people calling you in the first 24 hours. Let me share this real quick. Just because people always want to know about rates. So I'll beat you to it. You don't even got to ask. We can talk about it. Rates have been volatile, to say the least. And this is something that Mortgage News Daily, if you go, you can find this chart. You don't have to sign up for anything. You don't have to have 97 people call you about a purchase or refinance. Just an average from across the country, brokers, retail lenders, banks, might be lower, might be higher. Again, a lot of that stuff depends on the loan product, your credit score, your down payment. This is 30-year fixed rate conventional loan. And look at how volatile it's been just over the last week. Dipped down to 5.05. Truth be told, on the broker side, we had a bunch of scenarios that were 4.875 without any points being paid. People were able to buy the rate down to 4.6 for less than a point, and all kinds of great loans being locked in for a day or two. End of July, early August. And then this big jump up August 2nd and August 3rd. And then we had a really good day. Was that my birthday? Yeah, August 4th. Big drop. They did that for my birthday. And then back up. But like usually, look at this. Like from day to day, Thursday to Friday, goes up 5.09 to 5.45 on rate. That's significant. That's 0.3% in a day. And then dip back down. Today was another good day. So, you'll see this come out tomorrow and it might say 5.2. But I think the moral of the story, here's some history for you right here in this form too. Moral of the story is rates are volatile. You don't necessarily want to gamble and, have the opportunity to lock here and then see a good day and go, oh, let's keep watching it, see if it goes lower, and then have something like this happen where it goes up 0.5 point in 2 days. Don't get greedy. If you like it, lock it. That's the moral of the story, methinks. So that's a quick look at interest rates. I bought an espresso machine and I've got it in my office, and I still help Starbucks stock somehow. I probably got to cut down on coffee. Probably drink too much. North New Jersey market has slowed, but still very competitive. A couple people from Jersey. Matthew didn't weigh in, but VQuez, thanks for the info on Jersey. All right, we got a question here. Keep the questions coming, especially questions like this where, take my advice or not. I'm just going to give you an unbiased opinion on what I feel. And it's just one man's opinion, right? So wonder if I should sell townhouse in March, rental property, to buy bigger house since I'm going to be working from home. What are your thoughts of the market in March of 2023? Holy cow. It's hard enough to predict what the market's going to do next month, and you want me to talk about what it's going to do 6 months from now? Fair enough. What are your thoughts of the market in March of 2023? I mean, I think that this is something that I have conversations with clients every single day. People from my team have conversations with clients every single day. So I think that sometimes talking it through with somebody is the best bet for getting an answer. Just asking it out loud, it's hard enough to get all the context. But if we were to do a phone call, the questions coming from our side would be, what are the goals, right? So you own a townhouse in Florida and you're thinking about buying something bigger because you're going to be working from home. I think having the knowledge of what that larger purchase would look like is going to help you make a decision. Because what a lot of people are going to run into is, let's say you sell that home, and I don't know what the terms are of the current mortgage, but I'm assuming it's better than today's rates. If you have the opportunity to purchase or refinance 20 or 21, you've got some stellar terms on that. And just for rough math, let's say you've got an $1,800 payment and $120,000 in equity. what you might end up doing is selling this. It costs to sell. So let's say you net 100,000. Depending on how long you live there, you may or may not pay capital gains. If you do, then that might cut 25% off of that. Whatever you're left with, let's say you go put 20% down on this bigger house that you're looking for, but at a 5 1/8 interest rate, that bigger house is a $3,000 a month payment. If that's just out of the question for you to go from 1,800 to 3,000, then you probably answered the question right there, right? And wouldn't even necessarily consider selling. Another thing to look at too is maybe you've got a great mortgage on this property and plenty of income. You're not worried about the payment going forward, and you can look at, well, I've got a $1,400 payment on this thing, but I could rent it for $2,400. And you think about buying the next place with 5% down. I didn't really consider that I could buy the next primary 5% down, and that payment is whatever it is. Oh, the townhouse is free and clear? How much is the townhouse worth? And is there a possibility? I mean, I'm just a big fan of real estate, so I'm going to be biased, right? Is there a possibility to keep the townhouse and buy that $500,000 house with 5% down? I ask that because, free and clear, maybe you sell it and you get 150 grand net to go buy this $500K house with 10% down plus closing costs, put a little money in the bank. But if you've got that townhouse that even after taxes, insurance, everything else is paid, it's kicking you off $1,200 a month, and you go buy this new place with 5% down, even if your payment is $500 more per month, if that townhouse is kicking off $1,200 a month, I just love me that long-term appreciation of real estate. That monthly, I think rents in most markets, Florida for sure. See, look, we just talked through it. Buy with 5% down, keep that one. To Joey's point, like, you can consider getting a HELOC, and I'd look at that now, right? Like, you don't necessarily want to go borrow money and then use that, line of credit. Eric, all your pals on here, Eric and Joey, they're all about some sort of home equity line or line of credit on that one. Help buy that one going forward. We got a collapse coming? Eric, tell us more. Is buying land the right move until the collapse happens? The only problem with land, and why I'm not a huge fan of land, is it doesn't produce any thing at all. When you buy a $50,000 piece of land, you just got to pay taxes and insurance on the thing every month until you do something with it. The collapse that you're talking about, I don't know when it's coming. If it's coming, how severe it's going to be. But what if it's like a 5% correction, 7% correction in your market? Some markets might see 10, 20%. I don't think any markets are seeing 60%. I don't think, markets that are healthy are going to see any major correction. So I think that, like, part of me roots for it, right? I'm on the buy side. I want everything to get cheaper. I want everyone to be able to buy. If homes went on 30% discount, my business would double. It'd be easier for buyers. As an investor, I would be ecstatic, right? I just don't see it happening. So, like, part of me roots for it, right? Because I've got, like, no necessarily, like, investment with sellers, right? I don't care if a seller gets 500 or 415. Hopefully they get 415. That means the buyers, so I'm on team buyer, gets a better deal. I just don't see it. Like Mike Simonson from Altos today was talking about like if real estate is going to have a soft landing. No crash, really, just a soft landing and a little bit of a ease towards normal. A lot of the signs point towards that. A lot of the fear mongering, crash folks are just, the stars aren't aligning for them. Mass foreclosures, not happening, nowhere near it. Tons of people listing their homes for sale, not happening, not seeing it. Like less people listing than in years prior. Less. Inventory up, true. More listings, not true. Like data is data. And so it's going to be interesting to see, if we go into a market where sure there's less sales happening, but that doesn't mean the market corrects, crashes, goes down 30%. All right. I'm rooting for it too, man. Hopefully everything goes on sale. So you develop Walgreens and Dunkin'. I mean, I think that the opportunity for you, Eric, just thinking about it from a business perspective, because I like business and like thinking about those type of things, is what markets are going to emerge from all the change that's going on over the next decade or two. We've already seen what's happened in Florida and Texas and Idaho, and people are moving, relocating, taking up, roots, in my opinion, more than I've ever seen, right? And I'm just a young guy of 42, but there's going to be some clear winners over the next decade or two and some losers, to be quite honest, where whether it's, political or taxes or quality of life, whatever it is, people are going to continue to move. Companies are going to continue to move. And, sooner rather than later, I feel like whether it's remote work, which is part of it, or it's just the fact that like the big companies and the tech companies aren't just Silicon Valley. It's Silicon Valley, and you've got a hub in Austin, Texas, and you've got something in Florida, and you've got something up in Tennessee. Like there's going to be more opportunities in more markets, because I think a lot of the business stuff won't be centralized in just one or two markets. People who work in tech are going to be able to live and work in, if not many more markets, all markets, right? If a certain percentage of work is like, hey, listen, if you're efficient and we can track, your work and your work efficiency from home, then, work from Nebraska for all we care, as long as you're able to get the work done. And, that's going to draw down some of the markets where, hey, if you want this tech job that pays $200,000 a year, you've got to live in this specific part of the country that also costs $1.2 million for an entry-level home. I don't know. Just my rambling thoughts. Joe, you've always got the best questions, brother. I appreciate you. I appreciate you for a lot of things. For this comment is one of them. Smash the like button for the YouTube algorithm. Whatever it does for YouTube, smash it. And then I'll answer this question as well. You got some great questions, brother, because I know you're actively involved in real estate investing and following all this stuff. Sometimes follow it, get stories before I do. This one is really popular, and I would say trending, right? Is like, oh, structure your mortgage, put 19.5% down. You get a better rate. And yeah, you got to pay mortgage insurance, but it'll drop off within 72 days. The problem with this, Joey, is a lot of companies require that mortgage insurance to be on your loan for a specific amount of time, sometimes 24 months. So it's like, hey, you're going to get, it's pretty negligible, the difference between that rate and the 20% down rate with most lenders. As a broker, I've got access to a bazillion lenders. And so while you might save $500 or $600 off of the 4.99% interest rate by doing 19% down versus 20, it's because they got you $28 a month on PMI for at least 2 years. And the problem with it, besides that, is even after 2 years, the process for getting it removed is a pain in the rear, dude. I've got a property that my wife and I purchased in August of 2020, and it's got mortgage insurance. This company should go unnamed, but I can't even get these people to understand what I'm asking for. I'm asking to remove mortgage insurance. So the lady on the phone was like, oh, for sure. Easy process. I'll send you a letter to the address on file to get your mortgage insurance removed. They sent me something for removing escrows, like property tax and homeowners insurance, from being escrowed. Wrong answer. It wasn't what I was even asking for. That's a whole nother issue. But truth be told, like this is a hack that I think is probably more trouble than it's worth. If you find a lender that will have it automatically drop off when you reach 78%, which is the thing, it's not 80%, loan to value, then you're going to be paying it for months anyway. And I would just avoid it, man. Like all these secret hacks that people think they find, you think that there's just mortgage companies out there that don't know this stuff's going on to put something in place to protect against that. Their protection was just having it be where it's got to stay on there for at least 2 years. And they've done that years ago. If there's some podunk company that's not doing it, they're going to be doing it soon enough. Eric, the only thing I know about agriculture is tomatoes, cucumbers, strawberries, and some fruit trees that my wife has in the backyard. She loves her backyard gardening. And that's probably where my expertise of agriculture ends, is at my house with my lovely wife and all the stuff she's growing out back. I'm telling you, bro, an amazing cucumber and tomato salad with some olive oil. What else she put in there? Some olive oil and vinegar, some salt and pepper maybe. Amazing. But yeah, I don't know anything about agriculture investments, but I will support your Dunkin' Donuts ventures and go buy some coffee. I'm all about some coffee. I should start a coffee company. Let me see if I can find this. Oh, this would be cool. That ain't it. I'm trying to find the Get Better Everyday podcast. I found the Spotify link. All right, I'll put this in there. Since Joey brought it up earlier, I appreciate you, brother. There's the link for the Spotify. Get Better Every Day. Did it do it over two? Maybe that link doesn't work because it went over two things. Yeah, just go check me out on Instagram or TikTok or somewhere where I'm promoting the podcast. Get Better Every Day with Matt Gouget. We're 3 episodes in. I've recorded 3 or 4 more. I'm going to do it every week. A new one will be released every Friday. It's going to be fun. Get Better Every Day with Matt Gouget. It hopefully is going to be a lot easier to search soon. Get Better Every Day with Matt Gouget, Apple Podcast. When you search that, there's some other ones. Yeah, find it on LinkedIn or Instagram. That's probably the best place to find it. All right, back to regular programming. Let's do a fun crystal ball question. Do you foresee great price drops in your market for single family or for multifamily? I don't. I think that, like, if you look at the trends right now, everybody feels like, oh my gosh, price reductions galore. Things are coming down. Sellers are having to reduce their price. It's just like regular seasonal median home price declines. It's nothing dramatic. It feels like inventory is growing like crazy and we're all excited about it. It's 32% higher than last year, but it's 40% lower than 2019. Nothing dramatic. So, I see your follow-up. Larger price drops in your market for single family or for multifamily. This is a really good question, Joey. You definitely get the gold friggin' star today for the best questions, brother. This question is a good one to think about. As a guy who works with tons of buyers, tons of investors, investor mindset myself, as rates have gone up, like the numbers for multifamily have changed. And so I see some of this stuff sitting, and it excites me as an investor to look at, a fourplex that would have sold in a heartbeat at 500 in February, just sit at 450 and not have any takers. And I know the reason for it is because it's math when it comes to multifamily. If I could borrow money at 3.25 on a fourplex back in January, and now that same fourplex money is 6.5%, even at 425, it doesn't look nearly as good as it did at 500. We can factor in the fact that rates for rent have gone up, and that's certainly part of it. But with that in mind, prices are due to flatten. Maybe in some markets even see a little 5 to 10% pullback. If I had to guess, we might see it pull back a little bit more on the multifamily, just because, in my opinion, there's less emotion in multifamily. In single family, it's like the numbers don't have to work. It just has to be, okay, this is the neighborhood I want to live in. This is where I want to raise a family. I can afford $3,200 a month. Okay, let's do it. Multifamily, for a vast majority of investors, is what are the rents? When I plug in the rents to the cost of capital and I factor in capital expenses, property management, all the other things, what's my ROI, right? And if my ROI is 10% when I buy it for 500 and 3.25, to get that same 10% ROI, or even if I'm willing to do it for 8%, what am I going to pay when rates are 6.5? Even though multifamily up to 4% is still in the residential space, like I'm doing loans for up to 4 family, those duplex, triplex, fourplexes act like commercial, and they act like, a 5-unit, 10-unit, 20-unit, in that it's a number. They're worth a factor of what rents are to a certain extent. To most investors who are paying attention, and that math is important. And so some of the stuff I bought in 2019, 20, or 21 would be worth less to me when the cost of capital is higher, if that makes sense, right? One of my favorite calculators is that Chandler David Smith CDS calculator, where you can put in everything. And I'll look at properties through that lens, and granite countertops don't do anything for me. Other things don't get me emotionally attached to the property. Look at the numbers. So final answer, multifamily, we'll see more in terms of price drop than single family. A lot of people too, there was a lot of money floating around. People just want to park it somewhere. They couldn't park it in any sort of savings account or a lot of stuff that saw little returns. So they'd park it in investments Um, well, this question is a real easy one, right? Good evening, Matt. Is the best time to buy or continue to wait? This is loaded, but it's also too vague to know. Do you buy Tesla stock now or do you wait? Think it's going to be less expensive now than it is in 2032 when, Tesla's 10x the company is now, just because the stock market, to some people feels high or inflated or might come down. You buy and wait. You don't wait to buy, in my humble opinion. That comes with any long-term investment. Real estate's one of them. Stocks are another. I was talking to somebody the other day who was really concerned about the market, and they're going to have the similar stress if they buy a stock that they plan on looking at 3 times a day, every day for the next 5 years. If they plan on holding the stock for a decade and they bought it and they looked once every 4 months for the next 10 years, it wouldn't stress them out. So I don't know. I mean, I think there's so many different variables to this question. That is it a primary residence? Is it investment? Is your job stable? Other parts of your finances, do you feel like you got things, under control and you're in a position to buy? I think that's what I default to, right? Is not when the market is ready and when rates are at their lowest and that home prices at their lowest and you're timing it so you get the very best deal. It's when you personally are ready. Credit styled, your finances and your budget are in line. You've got a stable job that you're not worried about whether you're going to have it next month or not. And with all those things in place, an emergency fund, some down payment funds saved. If you're ready, it's always a good time to buy. I'm buying this year, next year, last year, 5 years from now, 7 years from now, and 11 years from now, every year, right? And deals will present themselves. Doesn't mean that every single piece of real estate is a good deal, but there's good deals every month in every market for somebody. Alex Rodoni. I bet you I can tell you where you saw that. And that specific, the McEwen, anybody who doesn't know what a McEwen is, it's a certain type of fourplex. And those, they were even cheaper than $300,000 in 2012, dude. I know some McEwens that were over by the Rayleighs in College Glen that you could buy for under $200,000. Gosh, I wish I would have bought those. I had a client buy one for $650 in 2020, and it's probably worth $850 now. $160 I could have bought these fourplexes for, and they probably rent for $1,200 per door. Imagine buying something for $160 that today would have net rents, all 4 units, of $4,800 to $5,000, like $1,200 to $1,250 a door. That is wild, right? Like $60,000 a year in rents, and you bought the thing for $160. Oh, sweet. But those specific ones, if you're talking about the ones that I'm thinking of, what's the name? It's like across from the Starfire light rail station. And I know enough SAC PD where there's more calls to that little row of fourplexes than like almost any other part of Sacramento. Parts that you would consider much worse. So long story short, I had a client who talked to me about that area, and I said, you're going to find a lot better areas to buy a fourplex for the same price. Unrealistic sellers in there, in my opinion. And only person you're going to get to find to buy for $800,000 in that specific, God, I probably shouldn't name it. I probably shouldn't talk smack about it, but it's nasty, and you're going to have a bunch of tenant issues and the police over at your property a lot more than you want. So it's wild. It's wild that it's gone up that much. Probably 4x at least. Can you fund a flip with a HELOC? Sure. You can, if you're talking about drawing a home equity line of credit from your primary and then going and doing a flip, you get a home equity line of credit for $200,000. Do with it whatever you want. Be careful. especially if it's a variable rate HELOC. Don't let anything be a luxury car purchase, a trip to Vegas, and Dogecoin. That's probably not recommended. But if you want to go do a flip, for sure. And as with anything, especially with adjustable rate money, especially when you're essentially taking a loan out against the place you live in, like, be careful, right? There's risk that comes with that. Don't get upside down and sideways with the flip. I've seen some great folks get in a pinch, right? So at your own risk, but for sure. How much supply you think we'll reach? Today, Mike Simonson on Altos Research said 535,000 homes. Some people think that's low, but even if we saw 600 or 7,000 homes by the end of the year, really low inventory, historically speaking. Benjamin Fajardo. I like this question because it's a common one. I had this conversation with a client literally earlier today. Under contract with a 30-day rate lock of 4.99%, 30-year fixed, no points. Does it make sense to refinance in the future at a lower rate, or should I buy points now to lower rate? First off, I don't know. Your loan officer doesn't know. You don't know. Nobody knows the future of rates. So counting on rates being lower in the future to refinance is something that we don't want to count on. The good news is at 4.99%, you're in a great loan. You're in a better loan than, truth be told, most people, at least who have bought in the last 3 to 4 months, are in. So you're winning there. What you want to do is, with whatever lender you're locked with, you're not locked to that specific rate. You can slide up and down, buy points. And I think that based on your question, you understand that. But you want to look at what that means. If you can go to 4.625 for 1 point or 4.375 for 2 points, I'm just throwing these out there. It's arbitrary, and rate sheets are different on every loan type and every scenario. Look at what that cost and what the payment difference is. And for example purposes, 4.99 is your default, right? Where you're currently locked at. You go to 4.625, and let's say that saves you $80 a month, and it costs you $4,000. We'll pretend like it's a $400,000 loan amount, and 1 point is $4,000. I don't know what that exact number is, but we're just making numbers up for this is how you're going to analyze it. The 4.375 is going to save you $130, and that's an $8,000 cost because it's 2 points. Rate sheets are going to be like this, where it's a law of diminishing returns. You're not going to get the same savings for the same cost as you keep going down. That first $80 in savings cost you $4,000. The next $4,000 you spend, you only save $50 more per month. Not exact, but again, that's how it's going to work. 4,000 divided by 80. I don't even have to use a calculator. That's 50-month break even. Then you go 8,000 divided by 130. I will use a calculator for that one. 61-month break even. You have to analyze in your own head, what are the chances I refinance this thing in the first 50 months, 4-ish years? And if the chances are like 100%, I'm going to refinance because I'm dead set that rates are going to drop. I can't tell you that for sure, right? I think that, you've got I've told people I think rates will go below 4% in 2023. I'm not sure of it. I won't bet on it. But if the Fed does what it does, it tames inflation. It increases the Fed funds rate to 4.5. When it makes its U-turn and it starts pulling back, especially if we go into a recession, that is going to pull rates back down. Whether it pulls them down from whatever levels they're at to 4.25 or 3.875 or whatever the case, I don't know. But here's the problem with the 4.99 is you only have so much room, right? $400,000 loan, you probably want 3/4 to 1 point lower in rate for it to make sense to refinance. The chances that things go below 3% are just really, really small. what happened in 2020 and 2021, I just don't see that very likely in the future for how the Fed is going to, very unlikely. So I probably lean towards not paying points, truth be told, right? Because once you spend that $4,000, it's a sunk cost. If you refinance, great. But if you don't, it's not a big deal either, because you're in a 4.99%. It's only going to make sense to buy down to that 4.625 in the scenario I gave if you hold on to the loan for more than 50 months. A lot of things can happen. You can move and sell. You could see appreciation in your market where you decide to refinance and pull cash out. You could refinance for other reasons. A lot of different things can happen. Things have changed where in other environments, people were refinancing more often, right? Nobody stayed in a loan for more than 3 years. I think those times are behind us. And to follow up with Mari, we won't ever see 2 to 3% rates again. Maybe not. Like, those were extraordinary times. What the Fed did with the Fed funds rate and pulling it back down to zero, like, is not normal. Like, that's not something that's, sustainable. We saw what happened with demand when we pulled rates down. Like, home prices went up 20% every year. Like, we don't want that either. And so if I were a betting man, Mari, I would say no. And it's not a bad thing. It's a good thing, right? Like, borrowing money at 4 and 5% isn't the worst thing in the world either. Yeah, that's that. All right, Robert. Follow up with what you mean here. Wait until supply continues come spring of 2023. I'm not sure if I know that. I'm with you. Probably long gone. Rates aren't coming down anytime soon. Probably correct. I know which condos you're talking about, Rodoni, on La Riviera Drive. I graduated high school in 98, and I went to Sac State until 2005. Don't judge me. I did a couple study abroads, and so I was lengthening my education. It wasn't that I was being slow. Just doing some stuff in Australia and Mexico. It was fun. But yeah, my dad told me to buy one of those condos, and I didn't because I was a traveling man. I didn't want to hold myself down. And those condos are now, between 300 and 400, and they were 50 to 60 back then. And then probably again, it probably dipped under 100 in like 2011, 2012. If we could go back, man, we'd buy a lot of that stuff for sure. Also worried if market corrects, I'll have to pay the appraisal difference along with refinancing cost. I mean, if the market corrects and you got a 4.99%, you're not in a terrible loan, right? I think if people really could see in context how great of a loan 4.99% is, like if you get stuck in a 30-year fixed 4.99%, you're in a good spot. If you get stuck and the market corrects like it did in 9, 10, 11, and you've got a 6.75 first that's adjustable and a second loan at 12% that's also adjustable, that's nasty. That's what happened to people back then when, loans were easy to get, but the terms were nasty. When I say 6.75 adjustable rate first and 12% second, I don't make those numbers up. That was the first loan I had in 2006. I had good credit, but it was a stated income loan. The nastiest part about that was that first was only fixed for 2 years, and then it started to adjust, and I had a 3-year prepay penalty. So if I wanted to refinance, I had to pay a penalty to get out of that loan. So thank your lucky stars, everybody here, that we've got 30-year fixed rate loans that are really good loans, especially when you compare them contextually to the whole history of time and other loans that are out there. Why do adjustables even exist? Of how crazy that sounds, anytime can change to market conditions. Well, some clarity around adjustable rate mortgages. A lot of people don't know. Vast majority of the ARMs that are being written today, like the ones that I'm personally writing, are 7 and 10-year ARMs. So these loans are amortized over 30 years. They're fixed for the first 7 to 10 years. So if I can get you a 10-year fixed rate jumbo loan for 4.25%, borrowing $1 million, versus a 5.25% that you might pay on a 30-year fixed, 1% on $1 million, quick math, is $10,000 a year. Quick math, it's about $825 a month. So, to Buffalo Bobby's point, for jumbos are definitely the way to go. You show somebody on $1 million loan how they're going to save $825 a month. They're not worried about what's going to happen in the next 2, 3, 4 years. They're in this thing for 10. The only thing with adjustables, you got to have a plan to get out of it. And so you just have to know what you're getting into. And some of them I've seen, what I see to maybe the 5 years that can adjust up to 5% on that first adjustment. That might be scary, right? Especially if you don't necessarily have a plan, or you don't know if you're gonna be qualified 5 years from now. You get into something that's 3.5% or 4%, but it can go from 4 to 9 on that first adjustment in 5 years. 5 years will come pretty quick. So be careful for that. I don't know why you said sorry for unprofessional comment. I think that it was a great comment. I mean, it's a question. Why do adjustables even exist? I appreciate the comment. I appreciate that I was able to answer it. And I agree with Buffalo Bobby here that they're great. They're fantastic. You don't have to necessarily be a savvy client, but they make a lot more sense on the jumbo side than they do for the conforming loan side. All right, Benjamin Fajardo, I bought in 2005 and foreclosed in 2016 because I was still underwater. I'm still traumatized from that ordeal. Thanks for the advice. I totally get it, man. I get the fact that 2008, 9, 10 really screwed people up. Personal story time. I bought in 2006. My now wife, who was fiance at the time, pregnant with our first kid in 2009. She was hospitalized for 2 months. I was still working, but couldn't get the same amount of hours. Like a lot of people, looked around and said, we paid $345. Things are selling around us for $200, because by the time 2009 rolled around, things were declining in value and price. Was in a position where it didn't make sense to keep the house. Thankfully, I was one of the lucky ones that was able to modify and had a lender who accepted modification, because I basically told them, I've got a finance degree. I'm not sticking around in this loan and paying you back the $345 that is owed on this 100% loan for a house that I could go buy down the street for $200. So was able to get a pretty sweet modification where the second was forgiven. The first was locked into a pretty fantastic rate and kept that house, owned it 16 years later. But tons of people around me, tons of family members held on, foreclosed, short sold. It was nasty for a lot of people. And truth be told, it was nastier for the people that were trying to do right and not stop making their payments. Some people took advantage and didn't pay payments for 2 years and, kind of feel like they won throughout the deal. But, the folks that were trying to make good and making payments on a house that they owed double what it's worth probably got hurt the most. Good news for you though, Benjamin, like 30-year fixed rate money, that 4.99%, whatever the total mortgage payment is, taxes, insurance, let's call it $2,400. As long as that's a comfortable payment for you, it's fixed, right? And depending on what state you're in, property taxes shouldn't be able to fluctuate or go up too dramatically. So you can rely on that being your payment going forward. You're not in something adjustable. It's going to go up to $3,000 next year, $3,600 4 years from now. And so as long as you got some stability in your job, your ability to work and all that stuff, then you're going to be fine. Really, no matter what happens. Let's say you bought the house at 500. If it's worth 650 3 years from now or 450, it really doesn't matter much if it's your primary residence. If you're going to hold it long term, I can tell you with absolute certainty in 2042 that home is worth more. I will bet you both my pinkies, and I'll eat them live. And I'll bite them both like to here and bite it straight clean off the bone. If they're worth less in 2042, they won't be, right? Because real estate over time is going to increase in value. You're going to have 2/3 of that loan paid off. So if you're staying in it for the long term, you really can't lose. Folks that are more short term are going to, be at more risk. And so somebody who's buying, right now, if you told me I'm going to move to Phoenix, Arizona, and I'm probably going to be there at least 12 months, but a good chance I might take another job out in Texas within the next 24 months. Don't buy in Phoenix, Arizona, right? If it's a short stint, go rent something. Not necessarily an advocate for renting in many circumstances, but if you're only doing a short stint, you don't know you're going to be somewhere long-term in a market that's seen 50% appreciation the last 2 years, you might not want to buy there, right? It might see a 15% correction. Then all of a sudden you're stuck with something that you paid $600 for is now worth $510, and you're selling it minus the fees. You're upside down quite a bit, right? So long-term real estate, you always win. I'm with Mr. Commando or COD Commando, bullish on real estate, but only in the long term. Thanks, Bobby, for the love. Appreciate you. What's my opinion on Rockland new home company builds? They're asking $950 today. However, maybe $890 to $900 comes November, December. Properties located in Rockland Meadows. I'm headed up from OC this Wednesday. Rockland is Placer County. It's close to me, and I do a good amount of business in Placer. I don't know specifically that subdivision, even though like Rockland, Roseville, Granite Bay, all those areas have really nice schools. So there's going to be a good amount of demand no matter what. I think time will tell, right, on these builders when they're presenting a product to clients that's got to pay 5% interest rate versus the 3% back in January. There's less demand. They may or may not have to negotiate on price. Really, time will tell. If the stuff that we saw with Altos Research is true, where there's only 535,000 listings at the end of the year, the home builders are still going to be in a position where they've got what is an attractive product because it's in a great neighborhood in a market with not a ton of inventory. So they're not able to list it and have unlimited people bid it up, and every phase goes up from 950 to 990 to 1,030,000 to 1,070,000 over 4 phases. Like those days are for sure behind us. But there might just be enough demand where they can sell out at 950, and then the next phase they either sell out at 950 or even bump it to 960. Stuff that I saw the last 2 years with new builds where they would have you pay these crazy lot premiums. You would also, like in some cases, have to bid against other people on new builds. That stuff was ludicrous. That stuff, for the most part, is behind us, I think. But I wouldn't necessarily count on it 5 or 10% reduction, especially considering like Rockland's a desirable area. Lionel McCrory, what's up? Hope all is well, man. I think it might be a year or two since we saw each other at a real estate meetup, but someone who's active in real estate, investing in real estate, it's cool seeing you on here. I mean, sustainable is just a matter of supply and demand. Rents are friggin' ludicrous. I've got some rentals in Sacramento, some rentals in other markets that are a little bit outside of Sacramento. And you're right, man. 2-bedroom is like 2,000 or more. 3-bedroom, I saw something recently where I realized how under market some of the rental properties I own are, but 2,700. It's wild. And I think that it is sustainable. I think that rent increases will slow down. Rent price growth will slow down, but not a ton. The last I looked, and this is a nationwide number for what's it called? The vacancy rate was like 0.8%, meaning that like there's not a lot of rental product out there. And the only way that rents are going to come down is if there's a bunch of rental product out there and nobody wants to rent it. Well, we got the opposite problem right now is everybody wants to rent. People are still applying. A little tidbit for you too, Lionel. I've got a client who had a small 3-bedroom in East Sac. They were renting for $3,200 and they got 15 or 16 applications. And they realized like we could have rented that thing for $3,500 a month. Small, like 1,100 square feet in East Sac. It's bonkers, man. Reminds me of, some Bay Area type stuff. And for Seth down in San Diego, he sees 1-bedrooms going down there for $2,200, which I believe, right? Probably 4,000 for a decent 4-bedroom in a decent neighborhood in San Diego. But that's the thing about the market is that rents are high, prices are high, it's all expensive. We can't hide from that, right? And as it gets more expensive to buy a home and it costs more for the people that own it, they're going to charge more to rent it, right? So that's not slowing down. You got to pick your poison, really, if you're a home buyer looking to purchase. You can have expensive rent or an expensive mortgage payment. You choose, right? You're going to pay the landlord one way or the other. The landlord's either you and you're paying yourself, or it's somebody else, and that one's 100% interest. So it's tough. I get it. A lot of folks are stuck having to choose between two expensive things. All right, I'm going to answer a few last questions. I got to get back to work. I appreciate everyone who joined. Thanks for your opinion. I'll try to see what happens. I'll look to contact you. I never even mentioned this the whole time. Too busy chatting with you guys to even mention greatmortgagebroker.com. If you're looking to contact me and my team, we're more than happy to help. Go to greatmortgagebroker.com, fill out the form. I promise you we're getting in touch with everybody. 50 or 60 people a week are coming to us from across the country. Until now, not getting a lot of complaints, meaning we're getting back to people quickly, letting you know if we can help. Happy to pre-approve you, happy to connect you with a real estate agent in your market, which I can't announce that until next week, but we've got something cool coming next week when it comes to connecting you with a great agent. Stay tuned for that. I will talk about that next week. I don't want to talk about it now because the link is not live. I just checked it. But still get your pre-approval with us. That comes before the agent. Then we'll connect you with a great agent. Next week, as I talked about, we've got Ryan Lundquist with SacramentoAppraisalBlog.com. The dude is awesome. Check out SacramentoAppraisalBlog.com. Awesome stats Awesome stuff that's going to apply to all markets. You know, it's going to be Sacramento specific with some of his data, but it's going to apply to markets across the country. It'll be useful for people across the country. So anyhow, look forward to that next week. A couple guys that do real estate somewhere back east, I've got them planned, trying to get Mike Simonson on. So all kinds of good stuff, good conversation. The real estate market's changing quick. Mortgage rates are volatile. The market's changing. I'm going to give you boots on the ground, what I'm seeing, hearing, and feeling from buyers on a daily basis. You know, straight lace, no chaser. So that's that. Till next time, thanks for watching. I appreciate you guys. And until next time, as you know, we gonna see.